Hello and welcome to yet another episode of Sector Wrap. Today we are going to talk about two important sectors that have done well both on the business front and stock price movement on the stock exchanges. These two sectors are FMCG and cement sector. And to talk about them, I have with me Mr. Rashesh Shah, lead analyst, cement, ICICIdirect. Mr. Shah, welcome to the show. Let's talk about cement. Till now things were going off very well. Now, COVID second wave, which has struck us hard. What is the demand scenario? What is the sector view that you are working on as of now?
So we remain positive on the sector, and especially we have now passed through the challenging times. Obviously, FY21 was a more challenging year compared to this ongoing year. So going forward, we are going to see a very healthy growth in terms of demand. The reason being is that the underlying current demand continues to remain strong, especially in the tier two and rural cities. And in the upcoming budget, in the last budget, if you see that the government has put more focus on the infra development, and we have seen almost about 26% increase in the capital expenditure allocation. So that is going to give a healthy demand momentum, especially on the infra side, which especially in the road segment, power, ports, railways. And not only the budgetary allocation, but we are also seeing a very speedy execution on the infra side. If you see the road development happening on per day basis, then it is now currently happening at almost about 37 kilometers per day. So which is one of the highest speed ever, which has been ever seen by us. So all this momentum will keep up the cement demand very strong. And also the recent forecast by Met Department is also predicting a very good monsoon in this fiscal as well. So rural pent-up demand will also continue to remain robust. And moreover, we also have a very comfortable interest rate environment. We are seeing a note because of this lower interest rate, also our urban housing demand and will continue to drive the cement demand for next fiscal. So overall, considering all these scenarios, we expect almost double-digit growth for the entire sector. Though it will have a benefit of low base of last year, but demand momentum is expected to remain strong.
So you do not expect any big, dent on the future for cement companies and the cement business as far as the second wave of COVID is concerned.
See, although we are seeing some bit of supply side concerns in the cement space because lots of supply chains are getting interrupted because of these lockdowns happening in the states. But at the same time, correspondingly, we are also going to see a very good pickup on the vaccination drive. So what we believe is that FY22 to remain better than FY21. Last year we didn't had any clue, and we also didn't had any vaccination, or we didn't have any backup what to do. So this year we have, at least we can see in next 6 to 9 months time, obviously majority of population will get vaccinated. So the things which are looking hazy right now might not be seen in next 3 to 4 months time, though 2 3 months looks challenging for the entire sector. But we believe underlying demand continues to remain strong, and whatever demand loss which we might see in this 2 3 months will get covered up in the later part of this fiscal.
So for demand, it is expected to, it's looking up as you say. But on the cost headwind side, we are seeing the cost of power, cost of fuel going up. Your pet coke prices are up nearly 15% quarter on quarter. Your Indonesian coal prices are up 48%. Diesel prices are up nearly 9% quarter on quarter. So what is expected? Do you expect the margins to be under pressure for cement companies with all these cost headwinds?
In the last 6 months, we have seen a cost pressure building up for entire cement sector. But in the fag end of March, we have seen one of 3 to 4% price hike taken by all the cement companies to cover up all these costs. And in the first week of April, we have also seen another price hike to the tune of 3 to 4%. So these two price hike taken together, we are not seeing any margin pressure for the sector. Although we might see some margin pressure in this quarter's numbers, but going forward into the next quarter, we may see an impact for companies coming back to their normal healthy margin trajectory. And also in the past 2 3 years, what we have seen is that the consolidation has happened for quite longer period of time in the last 2 to 3 years. Major companies who are very strong have acquired weak cement companies. So due to this consolidation, pricing power is now coming back to the players. And even if you look at the cement utilization at this point in time, though many regions are operating at almost 85%, 90% plus kind of utilization levels. So because of this scarcity also, we believe ki the players are in comfortable position to do the price hike if at all, if they face any cost pressures going forward. So margin profile is expected to remain very healthy for the sector.
Do you expect any price hike soon?
Already, players have taken up recently the price hikes in the first week of April. So now, after 2-3 months, obviously we will enter into the monsoon season, which is generally a weak season and subdued season for the cement companies. So in the next 4-5 months of time, I don't expect any further price hike to be taken by the cement companies. And also on the cost side, if you see, then petcoke and fuel cost has also come up from the recent highs. In the March month, we have seen crude price hitting a very high level of 75 plus dollars per barrel. Right now, it has come down to 65, $66 per barrel. So on the cost side, also we are seeing some bit of uh, downward momentum. So that will keep the margin profile healthy for the sector. So that is beneficial on the cost front as well.
Region wise, which region do you expect to be a growth driver for the cement companies?
So in terms of region, we are betting more on the north, central, and eastern region. The reason being is that in these regions are more of a rural centric and more of a tier two cities compared to the western and southern region. And even if you look at the road density of these regions, then we have very lesser road density. In the north, central, and east, if put together, we have a road density of only 300 kilometers per lakh of population compared to the western and southern region, which is having 450 kilometers per lakh of population. So demand potential wise, these three regions offer more potential compared to the west and south region. And also in terms of capacity wise, if you see, then these three regions are widespread in terms of capacity. There is no overcapacity unlike south. So in terms of utilization level, we expect the players operating in this region to operate at very healthy utilization level. Though in south also we are not so bullish, but we remain a region specific. Like AP Telangana is region is also doing well in terms of infra. Push. Lots of infra projects are going in AP and Telangana, and Tamil Nadu also we are seeing a good pickup. So in the south, we remain state specific rather than being remaining positive on the entire southern region.
Talking about capacity ramp ups, a few bit of companies have announced capacity additions also. Which company do you think is best placed to get benefited from this capacity adds?
In terms of capacity expansion, obviously the first name comes Ultratech. Ultratech has already, after expanding almost about capacity by 15 to 20%, they are now going more aggressive on their capacity expansion front. They had acquired earlier, like from Binani, from JP Cements. So they have successfully, after acquiring this asset, they have successfully integrated and make it a profitable in a just short span of time. So their cash flow is going to remain healthy, which will help them grow faster compared to the other players. So first one is Ultratech, and another company in mid-cap space which we remain bullish is on JK Cement. JK Cement also in the past year they have rightly commissioned their 4 million tons of capacity, and because of which they have also got a very good advantage of this demand momentum. And we expect their cash flow to remain quite robust over a period of next 2 years because of timely execution of their capacity, and that will help them grow faster in the compared to other cement companies in the mid cap space. So in Ultratech and JK Cement have played quite well, and we expect their growth trajectory to remain robust going
If
forward.
you have to recommend stocks to your clients, what would you prefer, the large cap companies or the mid caps?
So it's a mix of both because in the both segment we have an opportunity. So in the large caps, those who are risk averse, we recommend them to stay invested with Ultratech. And also in the large cap now, is Wholesale Group is now also now going aggressive in terms of expansion. If you have in the last AGM of Ambuja Cement, Ambuja has also said they are also going to increase their capacity from 30 million ton to 50 million ton. So this shows that how India is going to grow over next period of 4 to 5 years. Otherwise, generally foreign players don't remain very aggressive on the capacity front. They remain generally conservative in India. But the first time we have seen the foreign players are also now going very aggressive. So ACC Ambuja also we are going to see some catch up in the valuation as it has remained quite laggard in terms of stock valuation compared to UltraTech Sri Cement. So we are also recommending client to have some bit of an investment in this wholesale group companies as well because of the valuation potential. And in the mid cap space, we, as I said, we are recommending JK Cement because of their the management strategy has played well, and we expect that strategy to play out very well as we move on. And in the small cap space, we are recommending Sagar Cement. Sagar Cement also AP Telangana player, and it is one of the cost efficient player in that region. And company is also expanding from south to the central region. So in future, we will be having a mix of both in terms of southern exposure and central exposure. So that company is looking good to us from a 3 to 4 year perspective.
On the earnings fronts and profitability front, which company is best placed? Because we have been expecting very good numbers for all the companies in quarter four, and ACC, as the numbers are out, we are seeing a good sets of numbers for the company. I mean, which company is best placed as far as the profitability and the earnings for the next 4 or 5 quarters is concerned?
See, the companies which I have mentioned is going to report very robust set of numbers for next 2 to 3 years, like Ultratech, JK Cement, and so these two players are going to report very well numbers in this quarter as well and going forward as well. And other companies which we recommend is the Sagar Cement. As I said, Sagar Cement has also 2 years back they had announced the capacity expansion plan, and in this year, this fiscal bind of this fiscal, they are going to have a new capacity of about 3 million tons. So the companies which are on a high growth track, only we are recommending the clients to have a good exposure on that.
Thank you, Mr. Shah, for being with us, for sharing your views on the cement sector.
Yeah, thank you.
Now let's talk about the fastest growing sector, the FMCG sector. And to talk on this, I have with me Mr. Sanjay Manyal, FMCG Lead Analyst, ICICIdirect. Welcome, Mr. Manyal.
Hi.
Sanjay, now the situation is back to square one. We have rising COVID cases. What do you expect of the FMCG sector now? Is the momentum back?
So, yes, so one thing which we realized specifically in the COVID last year, that though demand more or less remained intact for the sector, for the staples category, for the essential category, the supply disruption really impacted the Q1 numbers last year, specifically in the June quarter, where we literally see the manufacturing and the distribution channel impacted hugely. Some of the categories which were more essential in nature saw very strong growth as they resumed the manufacturing within this 20-25 days. And some of the more discretionary categories saw a dip in demand. So something like packaged foods, or for that matter, oral care saw very strong demand even after the lockdown was announced. But some of the discretionary categories like cosmetics, skincare products saw a decline in demand. And so demand scenario was pretty clear that the out-of-home categories, the more discretionary nature category, didn't really do much good for at least first half of the year, financial year last year. But the essential one grew very fast as the out-of-home consumption completely stopped. So a lot of categories like biscuits, noodles, or the staples really saw a surge in demand. Even something like edible oil saw a surge in demand with a huge, the home demand or the at-home demand coming. Second thing, we literally have seen last year that the rural sector or rural regions remained completely unimpacted by the lockdowns because the disease really didn't spread that high over there. Simultaneously, government spend were increased drastically, specifically in Narega and some of the other rural-centric schemes. And that really increased the income level of the rural population, and that literally seen a surge in the consumption level over there. how the things really have different now. Again, we have seen some of the lockdowns coming back. These are more regional lockdowns, or more specific state-wise lockdowns. So there is no doubt that the discretionary or the out-of-home category again will be impacted. But we believe that those categories may not be impacted as high as it did in last year. However, there is one concern which still remains, and which probably we need to really monitor and see over the next few months, is the rural demand. Because one thing is pretty clear, that the disease or the spread of COVID is now slowly gripping into the smaller cities, smaller towns, and simultaneously the spend which government did last year, we are not very sure that that kind of spend really will happen now or not. So that thing which we still need to monitor. And yeah, if lockdown comes, then obviously the discretionary category will remain impacted, at least for 1 or 2 quarter more.
The positive that would happen for the FMCG companies is the IMD forecast another normal monsoon. So, how do you expect that to play out for FMCG companies?
So monsoon, yeah. So monsoon generally had a good monsoon have a positive impact, because of the, in terms of the rural growth. Generally, crop volumes are good, but it also have one connotation, that the oversupply problems of the crops many times impact the pricing also. But I think overall basis, good monsoon should be considered good for the rural growth. Specifically, if we just see the nature of distribution network expansion, which the bigger companies or the organized sector is doing, many of these companies had a distribution network in the urban areas, and the rural distribution is generally served by the wholesale channel. But more and more companies are now increasing their distribution network to the rural areas, which is something good, and which we believe probably will help them grow over the period of times. And certainly good monsoon help really create that kind of demand of the organized sector.
How do you think rising inflation in food and its derivatives, your palm oil, your copra, is expected to impact the gross margins of FMCG companies, because the prices are on rise?
Yes. So that's one thing. Generally, historically, we have seen that FMCG companies have the maneuvering power to maintain their operating level margins, because their spend towards the advertisements is very high. Generally, between 8 to 12, 13% of the sales really spend as an advertisement spend. And if whenever there is a cost pressure, we have seen historically that FMCG companies really reduce their media spends or the advertisement spend, and really maintain their operating level margin. There is no doubt that palm oil prices specifically in last 3-4 months have risen sharply. We have seen almost 25% year-on-year growth. Copra prices simultaneously have also risen sharply, almost 20% kind of increase in the copra prices. And the benefit which I think a lot of FMCG company got last year, second half of the I would say calendar year of 2020, in terms of crude prices, is also now sort of going away, because crude is also inching up. So what we believe, packaging costs will also increase. However, what we believe that FMCG companies were working on a very elevated margins. So HULs of the world were really working on a 25% kind of an operating margin. So some kind of a decline or some kind of a operating margin contraction for 1 or 2 quarters can be expected. However, generally FMCG companies have the pricing power. So ultimately, these prices will be passed on, and probably the second half of the FY22 would. We will see a similar kind of margin as these companies have commanded in last 2-3 quarters. So impact will be there, but it will be limited, we believe, for at least 1 or 2 quarters, and not more than that.
As far as the pricing is concerned, as you said, they might be hiking in times to come, but we are seeing marginal hikes happening in some of the FMCG companies. So can we expect an aggressive price hike in near future?
Generally, the price hikes never really happen very aggressively. So most of the time, companies really take a price hike in a staggered manner whenever required. And as we can see, we have specifically seen a very sharp rise in the palm oil prices have, as I mentioned, and tea prices also. So tea season was completely disrupted. One was because of COVID last year, because of labor availability was certainly not there, specifically during the lockdown, and simultaneously the floods in the Assam in last year also impacted the tea prices. And that was probably one of the instances where we have seen the companies had to take aggressive price hikes, because tea prices were literally 70-80% up. So at that time they really had to take the aggressive price hikes. But I think in general, companies take a very staggered price hikes and not very sharp price hikes.
Packaged food will once again benefit. Do you think so?
I'm sorry, I couldn't hear your question.
Packaged food category, do you think it's going to benefit once again and it's going to last long now?
Yes. So I think one trend which we clearly seen last year, that there was a packaged foods category which sharply seen a huge demand. One, obviously, a lot of at-home consumption was there, and we believe a similar kind of situation is there where people are still staying home, and the at-home consumption will rise. Second thing, which probably we believe were pretty much long-term in nature, which we believe had a really positive impact, over the period of time, is the shift from the loose products or loose foods to the packaged foods. So whether it is a atta category or the biscuit category or noodles or some of the or pulses, some of these category which very much consumed in the tier 2 tier 3 city as a loose product, has seen a sharp rise in the demand for the packaged foods. So there was a clear consumption shift from the loose to packaged foods and unorganized to organized brands, which we believe will continue, and that probably growth will benefit companies like Tata Consumer Products, or for that matter the foods part of HUL, or for that matter edible oil for Marico, or ITC FMCG, which is entirely mostly packaged foods, I would say. So these companies most certainly will get benefit of that.
Sanjay, what are the changing dynamics of distribution network? Things have been changing in last 1 year.
Yes, so I think again the clear trends, as I mentioned, the shift from the consumption of unorganized to organized or loose to package was there. So another example of the one of the trends which we have seen clearly, that there was a huge increase in the e-commerce channel growth. Almost entire sector, or all the companies which we speak to have mentioned that there has been almost 100% increase in the e-commerce sales. So that channel has become a very prominent channel, and I think the way the things are, as we have still not out from the COVID impact, we'll see the continuation of expansion of the e-commerce channel. Secondly, the general trade, which was struggling pre-COVID, has again come back. General trade has also seen a very good demand. What has suffered, in terms of channel, is the modern trade, because malls largely remain closed for a very long period of time. So modern trade has suffered a lot. General trade, which is the local kirana shops, have seen a very good growth, and e-commerce has seen a very good growth.
How are advertising spends changing over the period of time? Because initially we used to see all the FMCG companies advertising big way, both in the electronic media, but now the trend is changing, and basically the cost reduction is something that every company is working on now. So do you see the trend changing, and the advertising spends? How do you see them panning out now?
So I think a lot of advertisement spends have become very dynamic now. We have at least seen, and when we communicate with the companies, we will clearly see that a lot of companies now are concentrating on the digital advertisements, and internet and digital ways of advertisement have become very prominent. So TV advertisements used to be at one point 85 to 90% of the total ad spends, which probably I believe have become approximately 60-65%. So there's a large part of the advertising spend which is going towards the digital ways, and probably that trend again will continue. But one good thing about the advertisement is that, as I mentioned earlier, also that the companies many times invest at will on advertisements. Obviously, the new product launches and has to be supported by advertisement spend. But the digital ways and can really curtail down that kind of a cost. So despite the ad volumes remains probably same for most of the companies, but the spend can really go down considerably, which always help in terms of the margin expansion.
Which are your preferred bets in FMCGs?
So we believe that some of the large cap we have seen still remains a bit expensive and probably. But we clearly see, as I mentioned in my conversation, also the packaged food is a category where we see a very strong growth, and the trend of the unorganized or loose products to the packaged product is very clear, and clear beneficiaries are Tata Consumer Product. We also like Zydus Wellness. Mainly because of they have acquired Heinz portfolio 2 years back, and they actually have never seen a very consistent year or normalized year. When they acquired Heinz, it was a half, almost half of the years were accounted for it, and the FY20 last month impacted by COVID, FY21 remain impacted with COVID. So probably FY22, we are hoping that will be a normalized year, and once the potential of those brands and the changes which Zydus have done in terms of the distribution network, in terms of the expansion of portfolio from one particular region to the entire channel, and the strong doctors advisory strength and the chemist channel network will also benefit all these brands which they have acquired, whether it is Glucose or Complan or Nycil. All these brands probably will see a strong growth, and Zydus probably would be benefited the most in current times. Tata Consumer Products already run up very sharply in last. The stock has run up very sharply in last year or so, but I think that will remain. That will probably continue to outperform the FMCG sector.
Sanjay, what's your view on ITC? I mean, we have been hearing a lot about the management working on segregating the businesses, dividend paying company ITC, but the kind of investment interest in this stock has been limited. What's your view on ITC? Would you be a buyer in ITC at these current levels?
So ITC, so two clear trends are pretty clear. As I mentioned, FMCG portfolio is a very strong portfolio now. We can see it's almost 70-80% kind of portfolio is packaged foods, which has a tailwinds of either COVID or the consumption shift, and that entire portfolio is going to grow strongly. The second also thing which we have seen, which the company has clearly indicated and even seen, we have seen that history in the last 2 years that they are continuously increasing their operating margin of FMCG business, which is a clear indication that the FMCG part of the business should get a high multiples compared to the current ones. But the clear laggard is the cigarette business, because cigarette business is a business which over the years has not seen any volume growth, and which has a lot of headwinds in terms of the growth can only come from the prices, and there have been at least in the past, if not in last 2-3 years, but before that, continuous increase in the excise duties and the taxes has really impacted the most that sector. So demerger could be a positive thing. Dividend payout which they have already executed last year. We have seen they have given almost 10 rupees in the March quarter, and again they have announced 5 rupees dividend. So a huge jump in the dividend payout. So these things are positive, but we still believe that a strategy which came into media sometime back, that demerger is a possibility. Those things probably can do well for the company, because FMCG part probably can get valued much more. And then let's see. I think cigarettes still will remain a laggard for some time. It will not get a kind of value which the FMCG generally gets.
Thank you, Sanjay, for being with us. It was a pleasure. Thank you.
Thank you, Ritu.